Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover many topics related with balance sheet and statement cash flows. A typical balance sheet reports the financial position of a company at a point in time, for example, end of the quarter or end of the year. And there are three components a typical balance sheet can contain: assets, liability, and owner's equity. Assets provides information about economic resources this company has. Liability provides information about obligations to creditors. And owner's equity is the net resources this company has. For example, it equals asset minus liability. In terms of the usefulness of a balance sheet, first of all, it helps us to evaluate the profitability of a company. We can use the balance sheet information to measure return on equity or return on asset. Let's look at the return on asset. It equals net income plus interest expenses, after-tax interest expenses, divided by average total asset. So this ratio helps us to understand for every $1 of total assets, how much return this company can generate for all the creditors and all the shareholders. Return on equity equals net income divided by average shareholders' equity. This ratio measures the effectiveness at managing capital provided by the shareholders. It tells us for every $1 of shareholders' equity how much net income this company can generate for us. Secondly, this balance sheet information can help us evaluate asset turnover. For example, we could calculate the total asset turnover, which equals sales divided by average total asset. So this ratio straightforwardly tells us for every $1 of total assets how much sales can be generated by this particular company. So, in another word, this ratio is measuring a firm's ability to generate sales from a given level of assets. Thirdly, it can help us to understand the capital structure. For example, we could calculate debt to equity ratio. It equals average total assets divided by average shareholders' equity. This ratio measures the extent to which a company relies on borrowings. And balance sheet information can help us to assess a company's risk, short-term risk and long-term risk. Short-term risk refers to whether the company can pay short-term obligations like employee salaries, like interest. Long-term risk is about whether the company can pay long-term obligations like long-term bonds. For the short-term risk, we could calculate current ratio, which equals current asset divided by current liability. This ratio measures the solvency in the sense that current assets can be used to meet current liability, which means for every $1 of current liabilities, how much current asset they have to cover every $1 of current liabilities. For the long-term risk, we could, for example, calculate operating cash flows to total liability ratio. It tells us the ability of the company to pay all liabilities from cash without new debts or additional investments. For the limitations of balance sheet, first of all, most of the assets and liabilities are reported at a historical cost. Those historical cost information are very reliable, but it is less relevant to the current market participants because those information are old. They probably represent the values like 10 years or 5 years from now. Well, the current market participants, they want information about current market values. Secondly, balance sheet introduce subjective estimates. For example, we ask managers to provide their estimates about the future uncollectability of accounts receivable. We want the managers to provide their estimates of possible these depreciation expenses related to those planned assets. So those subjectives actually provide managers lots of opportunities for their misreporting. Thirdly, lots of the informations are ignored. For example, employee talents, CEO talents, customer satisfaction. Those information are very important for the investors to predict the future cash flows. However, since we do not have an objective measure to measure those information, they're actually ignored. So we sacrifice those information, important information, for objectivity.